My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Skanda, Amarnath. Skanda, introduce yourself to the audience. Who are you? What's your background? And what are you doing with Employ America?
Sure. So thanks for having me on again. I am the executive director of Employ America. We are a research and advocacy organization kind of focused on the macroeconomic policy tools that are relevant for maintaining a high employment, strong wage growth, strong economy overall. And prior to my work at Employ America, I worked at a macro hedge fund for 4 years as a sort of hybrid economist strategist. And working for PMs, doing more pecuniary activities. And then prior to that, I was also at the New York Fed for 2 years. That's a short description. I'm happy to go into more detail about what we do, but also just looking forward to the conversation about what's been certainly a very interesting moment in macro and markets and the economy as a whole.
Just for the audience, what exactly does an advocacy group do? I mean, what's involved? Why have it? What are some of the things that you're trying to achieve?
It's a different set of it's thinking about research from the standpoint of what should policymakers be doing, right? So that there's definitely a prescriptive element of it. First, you got to be able to describe what's going on in the economy well, to be able to say, if you can think about certain diagnoses, where are some areas where policymakers, whether they be at the Fed, whether they be at agencies, whether they be at Congress, like different opportunities. And look, there's all sorts of lobbying and all sorts of things that happen across government. But we try to find those areas where there's like actually room to get some stuff done, where there may be either the right political alignment, plus like there's actually some underrated opportunities to do some good. And so, yeah, we obviously have a certain worldview about how the world works. Obviously, that's like something everyone can debate until the cows come home. But then from there is translating that from like a research view into a what should you do if you're thinking about like the current environment? What are the sort of risks on all sides? And look from the standpoint of prioritizing employment outcomes and wage outcomes, you might get to different answers. And if you're trying to prioritize other outcomes, so it does kind of depend on like your compass is going to be guided by that too. But we do actually try to engage with policymakers directly, lawmakers across the partisan spectrum. So we're trying to sort of take a somewhat big tent approach to advocacy there. But yeah, it does require kind of thinking through all parts of the problem, from the politics to the implementation to the actual economic and like technical knowledge hopefully required to actually implement good public policy.
So, on FinTwit, everybody has an opinion on what the Fed should, in quotes, do or not do. I'm curious if you think that the role of the Federal Reserve has shifted over the last several years from being anticipatory to more reactionary. It seems like if all they're doing is based on all their decisions are based on recent data, then they're just reacting to data rather than trying to anticipate shifts in it.
I think that sounds pretty accurate to me. I would say that they have definitely moved from trying to take a more forward-looking view about things to, as their forecasts of the world have not complied with reality, they've shifted to something that's a lot more reactive to the latest, especially CPI releases, I'd say. CPI releases have obviously moved markets in a much more meaningful manner in the last 15 months than they had previously. You stack on top of that sort of like even stuff like everyone now gleaning every little wage release, how much to weigh it. There's obviously some sell side commentator telling you that wage growth is going to the moon. And then there are some people who say, no, if you look at this weight measure, it's actually going down. And then there's obviously like a lot of like macro theses that are built around that for some good reasons, because just the Fed is a pretty powerful actor, for better and worse, in terms of how they can change perception. So whatever the Fed's thinking is somewhat like a kind of reality of its own, because they set risk-free rates, and that's obviously part of the math for every single asset price in the world.
Yeah, and it's amazing to me, right? In a world of so much quantitative data and ways of slicing and dicing to come up with what's to the right of the equal sign, there seemingly is just so much variability of mindset and opinion, at least among different commentators. I remember a study that was done, 20, 25 years ago that the Fed itself had done. And they were basically looking at their ability to predict the future versus Wall Street. And they found out that their forecasting ability was no better than a sell side analyst, essentially, which was kind of damning as far as all their PhDs. But as you kind of think through all the data that you review that you think matters the most, do you get a sense that the Fed is viewing things correctly, or are they once again behind the eight ball?
So, I mean, I think if we take one step back here, like the kinds of people who tend to select for working at the Fed, right, are not the people who tend to select for going to the sell side. Um, and like the sell side has its own perverse incentives, but if you want to like try and get the macro data releases right, you want to think about like as the data comes out, like if your job is to nail that forecast, some people focus on doing that well, and some people focus on telling a good story that attracts like a set of PMs and traders to trade with them. So that, as I said, that's perverse incentives. But like, if you want to get that right, that's like what you go do. You go become like a market economist. If you are aspiring to be something of an academic, someone who's trying to publish papers, take a more retrospective view, like work with lots of data that's over long periods of time, answer some key academic questions. The Fed's actually a pretty good job for that. It's like kind of like being a professor, but instead of teaching, you do some policy work. That's kind of a better description of, I think, what the Fed's, like a Fed economist's job is. And so I don't think that really lends itself to being like sort of subjecting yourself to what we think of as like kind of the market test, right? In terms of like, you're not trying to, your job is not to be a great forecaster. There's a generally an attitude of, well, forecasting is hard and maybe it's a waste of time. But I do think in the process, you kind of lose track of all sorts of things, a lot of nuances that I think some of the really excellent market economists I've seen, at least through my career, really have a detail-oriented view of like, how's the data actually measured? I mean, we can call something inflation, we can call it wage growth, but if you don't know how the sausage is made, you can end up like just tricking yourself into like adopting a lot more theory. I think the Fed's got like that, some of that mindset in terms of, let's say, for example, inflation. I think it's a very like we all kind of understand on some intuitive level there is some relationship between wages and prices. It's not zero, but I think it's like beyond that, like being able to say, oh, this part of inflation must definitely be caused by wages is kind of where like the Fed's definitely done this in a few places. And I see that as like a very strained, like, oh, I got to start from the Econ 101 textbook that tells me some relationship here. Yeah, there's some advanced graduate level econ you can apply to it and say, oh, there must be some relationship between wages and prices. But if you actually try to do the work of saying, well, where would this actually show up? Have we tested these hypotheses? Have we back tested? Have we tried to see how good of a forecasting model this really serves as, or at least some kind of model that holds up over time? You'd be left underwhelmed. But I see the Fed as like trying very hard right now to say, well, we know this part of inflation must be caused by wages, and so therefore it's like we're just going to kind of presume it to be the case. So that's kind of an example of where I would say if you were really trying to hold your feet to the fire, trying to say like get every forecast right and every wrong forecast you learn from, learn the right lesson from, you probably wouldn't take that view. But the Fed, I think, has a little more of an academic bent to it, and so it does creep up in various biases.
Yeah, and among those nuances are the various lags of policy and when it shows up in the data. All right, I mean, the whole monetary policy act with long and variable lags seems to be somehow lost. I'm always blown away that whenever there's some data point that comes out, the narrative is, well, the Fed has to keep hiking because of that recent data point, but that recent data point is based on interest rates from many months ago.
Yeah, I mean the SVB stuff is quite a good tell, right? I mean Jay Powell was, at least in my opinion, I think there's room for some different disagreement, but like I think he wanted to hike 50 basis points at the March FOMC meeting prior to the blowup of SVB. I think that was pretty clear from Humphrey Hawkins' comments. He was saying if CPI comes in a little spicy, like we got to go 50, and that kind of reaction function just like revealed they didn't have their finger on the pulse of like what was going on with the Silicon Valley Bank. Sort of challenges that kind of emerged very quickly, or at least got onto their radar pretty late in the game. I think of that as a perfect example of like long and variable lags. Like, yes, a lot of the Silicon Valley Bank failures are a function of bad risk management, all these other things that we can point to, supervision. But like at the end of the day, there are some like very specific reasons for those vulnerabilities that are that tie back to interest rates, both on the deposit flight side and on the in terms of their asset position. Those things take time to emerge, and if you're someone who's like, I think there are two types of like FOMC members. I kind of would classify them into, just being reductive. One is like your sort of like regional Fed president who is not a macroeconomist by trade and is like very keen to understand, I'd call it the mechanisms. So thinking about like, the Fed sets interest rates. How does that affect the financial system? How does the financial system affect like different parts of the real economy? How do those parts of the real economy affect inflation? I'd put myself as someone who tries to think in that camp. And then you have like macroeconomists who are like, kind of think of it as like, well, inflation's X. That must mean like real interest rates should be Y. And if I solve backwards, that means that the Fed funds rate has to be in this at this rate or this like range of rates, and kind of takes a more top-down view. I think that sort of can be pretty dangerous because then you don't actually understand like, wait, so when the Fed's raising interest rates, it does all these different things to the financial system, things that, let's be honest, the Fed has generally never shown a great curiosity for. The Fed seems to be much more comfortable just saying, tell me where the macro variables are for unemployment and inflation, and I'll try to that'll guide my next interest rate decision. That's roughly speaking how I'd say the Fed thinks about these things. If they go through the actual mechanisms underneath it all, I think they would probably have been more on top of stuff like the Silicon Valley Bank fallout. Because in the end, this is like an example of what you're talking about, the lags of policy. These things oftentimes take time to emerge, and the only way you're going to be able to know what's going on is by paying attention. You can't just say, like, the CPI release is not going to tell you anything about like financial system vulnerabilities. Like the CPI release is like the end point of a causal chain, but it's like hardly the first point.
Yeah, no, and I don't know. I find it bizarre that presumably Powell and his cohorts are intelligent. They must know this. I had put out a tweet back in October saying, in a year from now, it'll be clear that the Fed already over tightened. We'll see if I'm right or not on that. But to your point, I mean, a lot of the SVB stuff is just sort of a delayed response. Now, as you think through other delayed responses, let's talk about risks that could happen later in the year if the Fed maybe has already over tightened. And maybe I should take a step back. What's your sense? Do you think the Fed has already over tightened, or are they just about right? Is there still a lot more to come given some of these lags?
So I'm always a little bit circumspect in calling certain things like recessions with any kind of certainty, because like these things have historically always proven hard to like call with any kind of certainty and are kind of fool's errand. The risks are really high. I don't think it's obvious that they've necessarily over tightened, but I think the further they go, the higher the risks. Right now, we're kind of in this weird place where you're hearing a lot of information about bank credit conditions tightening, and at the same time, capital market conditions look a little more stable. And so that maybe that's like an ideal balance on some level because you'll get some offset. But the higher they go, and I think this is part of what you're seeing with sort of the bank funding conditions, you are going to see bank profitability probably take a big hit, and you also see bank sort of the kind of capital budgets that are attached to lending activity. Those are going to be shrunk over the course of this year. I don't think that so we're kind of faced with different cross currents. I think the Fed's probably just given how fast they hiked rates, and I don't think the Fed thought hard enough about like the speed. And like, look, we'll find out. Maybe the economy will ultimately digest it, because I don't think it's like obvious we're at a sudden stop here in terms of the economy itself. But I do think that they are only at the beginning of learning how much tightening they've really done. And so if you really want to make sure you're learning as you're going along, it kind of probably helps to pay attention now and probably slow down. The Fed probably should be in just like a stronger version of risk management mode than I suspect they're really in, because they've already done a lot of tightening, and I think what you're kind of gesturing at here strikes me as very plausible. Maybe it should be the baseline scenario.
And a lot of that also is because the bond market has given them leeway. I mean, credit spreads have not really widened to a degree that the Fed would normally be concerned. So if they're taking cues from the bond market, right, then sure, they want to raise rates. But at the same time, the bond market itself has never really seen rates move this quickly either. So it's If you're looking to the smartest one in the room, which you can argue is credit spreads, the smartest guy in the room hasn't seen this either.
That's right. I think it's like you are seeing like I think there are people who are in the say the treasury market who are probably thinking about like say Fed cuts more as like a recession hedge, right? You think about like how everyone talks about there's still Fed cuts priced in to 2023. It's like no, that's like a recession hedge trade, right? It's like a if these sort of more SVB type instances show up sooner, and there's like a decent scenario where that's the case, then then like the Fed can say all they want about how they're going to stand pat, but if the financial system's blowing up, they may have to take rate adjustments. Obviously, that's a scenario that's probably negative in so many other ways, but I think of that as like you've seen the like in general, credit spreads have been a little more well behaved than the Treasury market, Treasury yields, and Fed cuts, pricing in of Fed cuts might otherwise imply. So to me, it's like it's not obvious that we're like that the whole that a recession is like imminent or about to happen the second half of this year. But the risks are like, yeah, the nature of monetary policy is like there are different parts of this big like economic and financial beast that move at different speeds. And so, yeah, like when the Fed raises rates, it changes the price of treasuries instantaneously. Sometimes it changes the price of equities and price of credit, capital markets quickly. But like banks tend to move a little with a little more friction. How it affects labor markets and then how it affects inflation. It's all like those things do take time. You can't like think that like a CEO or CFO is making a decision based on what Jay Powell says at a press conference. Those things kind of like it takes a bit of time for everything to filter into different economic agents.
What are some of the data points that you tend to focus on to help you figure out what the Fed should be doing, and in terms of communications that you try to put out to policymakers? I mean, listen, there's endless amounts of data. I'm always skeptical that data actually tells you very much. There's probably just a few data points that ultimately explain a portion of why the world acts the way that it acts. But what are some of the things that you tend to look at?
Yeah, it's a great question. It's a great point as far as there is probably too much data as far as at least like, look, there's a lot more things I look at than I think are worth communicating. I'll put it that way. I think there's a lot of stuff as far as the kind of core metrics I think about for the health of the U.S. economy, right, is and if I'm thinking about the labor market more specifically, then I think we should be talking more specifically about the pace of job growth, right? And so the pace of job growth tends to be commonly focused on in terms of non-farm payrolls, and it's definitely a useful indicator, but it's actually, in my view, quite overrated, just because it's quite heavily revised, and people like what you see in a given jobs report can just like look radically different 2 months from now, and we've just kind of moved on to the next headline. But like it's not actually necessarily the best representative of reality. There are other measures in the jobs report of employment that, while more volatile, are at least like what you see is what you get. So like the household surveys employment numbers, and specifically like employment to population ratios adjusted for age, that to me is like a good sign of like the actual health of the economy as we see it now. It's not going to change in 2 or 3 months retrospectively. We don't have to worry about revisions. So I look at employment growth, and then in terms of wage growth, there are a lot of different measures thrown around, but the one that's probably of most relevance to me, and I think probably most relevance to the Fed here, is the employment cost index. This too is a measure to me. I put a premium on measures that are not revised retrospectively in aggressive ways, and so employment cost index is not revised. What you see is what you get, and it adjusts. It's like not perfect. It's got noise too, in the same way that like the household survey employment numbers also have noise, but it does adjust for a lot of the biases and all these other wage measures that are out there. And I think if you put those two things together, and I tell you job growth and wage growth, what I'm telling you really is about like nominal GDP growth. I'm telling you about like measures of dollar flow of spending, whether that's employer spending on their payroll or household spending on consumption. Like that's kind of the stuff that really matters. And you want to think about that stuff specifically where it's like real observations of this stuff, not like imputed. There's a lot of imputed nonsense in consumption and nominal GDP. So if you can strip that stuff out and get a cleaner view of what's going on in terms of actual observation, that gives you get a ballpark. And that's to me, like beyond that, all the other stuff is kind of like secondary downstream. So it's good to think about manufacturing and housing and all these sectors precisely because they're very cyclical and precisely because they kind of shape the trajectory of nominal GDP growth and shape the trajectory of how much businesses are willing to spend on labor and how much of that is job growth, how much of that is wage growth. That's to a first approximation that hopefully gives you a good idea of like how I would sort of prioritize the data itself.
Let's talk about just going back to the name of the space, upcoming catalysts for the economy, for the Fed, for the markets, and all three don't necessarily line up, as we know, at the same time. What are some of the things that you're
Yep.
focusing in on the most? I'll tell you that I keep going back to the bigger catalyst from my vantage point is when the market starts to care about the rolling over of very low rate corporate debt next year. That's not something that's news driven. That's something where the market just suddenly starts to worry about it. But what are some of the things that you're looking at now?
Yeah, for me, I'll start with the really short term in terms of let's start with this week. And so this week itself, I think this is going to be a GDP release. And I think for people who are thinking that Q1 was going to be a recession, maybe there's some shock. But I actually think GDP is one of the most overrated and less useful indicators of the economy in general. I just told you what, like there are proxies of nominal GDP that we can learn and watch from in real time. But I wouldn't we're kind of expecting sort of a GDP number. It's pretty backward looking. It's noisy. It's not the greatest guide for things. What is probably useful for like teeing up what the Fed's going to do next week is like the Fed's probably going to hike next week. That seems pretty clear to me at least. But what they signal for future hikes, if they pursue future hikes, what that looks like, that will be kind of dictated by what we learn on Friday, which is your sort of what their preferred inflation gauges are and also their preferred wage gauge. And so I think there's some good reasons to actually think that those numbers may come in a little bit softer than what some of the, or at least they give some guidance for the Fed to say, maybe we don't have to hike so much or so aggressively from here. That's like certainly one scenario. At the same time, like as I said, these data points are pretty noisy. And even if you and I think these data points are pretty are like noisy enough that we shouldn't like take them super literally. Like I think the truth of the matter is the Fed does, and what the Fed thinks is important has its own importance to it. But I'm happy to go into more detail about sort of what's sort of driving these like wage and price releases that are kind of coming up on Friday specifically.
Yeah, let's do it because I think it's too people focus on just sort of the headline numbers, and again, it shows more about the inputs than the output, right? So let's talk about that.
Yeah, so I mean, so there's this thing that the Fed's talked about this thing, and I would not have elevated this just to be clear, right? But the Fed's talked about this thing of core services x housing inflation, PCE inflation specifically, and so this is like saying services inflation that's not rent and that's not call it your energy utility bill, so like gas and electricity. That for them is what they have decided to call like sort of the part of inflation that is labor driven. I find this actually quite dubious in terms of like labor matters for both goods and services, and it's not obvious that like the service stuff, a lot of that is like airfares, for example, month to month. The most volatile thing tends to be airfares, and that's mostly a function of things like jet fuel and capacity issues that are there's some labor component to it, but it's like not obvious to me that it's actually like driven by how much they're paying flight attendants or pilots. So when we like look at those categories, we get a decent guide from CPI and PPI, and that alone probably tells us that these numbers are probably going to be on the softer side relative to where they've printed in maybe the last few months. But on the other hand, there are some parts that are like we don't get to see until the PCE release. Let's call these dark spaces, I call them, because they are really opaque. We don't really know what they're supposed to reflect. I'll give you two examples of what these dark spaces look like, and they're kind of ridiculous. One of them is like literal wage data, but it's like wage data of a random set of things. Like what do life insurance companies pay their workers, and what do churches pay their the people who work for them? It's called the input cost indices. And so it's like kind of this like ad hoc group of things that like we can't see through CPI or PPI, but like actually has like underrated leverage on like what the final outcome is. So like 25% of core services X housing basket is like weird wage data. It's not like systematic wage data. It's just like these like sort of oddball sectors. And then there's another part of it. It's called like imputed financial services, which I think is like one of the places where if the methodology is right, it ends up having some odd implications. So it's supposed to be, think about like if you're at Bank of America, you're probably not getting paid a lot of interest, but you do get some other services that Bank of America may provide to people who have checking accounts and savings accounts with them. So what the Bureau of Economic Analysis, these statistical agencies tend to look at here is what you're getting cheated on your deposit rate relative to the Fed funds rate. That is effectively the price. I'm calling the price in quotations here for like your depositors are paying for their services. So it's like an imputed financial service. You're not paying for, let's call it free checking. You're just paying. You're just paying for it through getting a lower deposit rate. So what happens if deposit rates are playing catch up right now to the Fed funds rate? Effectively, that price is going down. This is kind of what happened in the savings and loans crisis. So what happened was deposit rates were outperforming where the Fed funds rate were for a period of time, and so it led to some imputed financial services deflation. And I'm really sorry to throw those words all together for our audience, but just to tell you, there are some ridiculous parts of the inflation mix here. But it probably puts some like extra downside risk if we are seeing deposit rates play catch up. Whether that plays out in the data precisely one-to-one, make no representations there. But I do think like that is how this is supposed to work. So we'll have that kind of in train at the same time. Like, so there are these two things that we don't get to see from CPI and PPI. It kind of comes out on the day of PCE. And weirdly enough, I suspect it will shape how the FOMC thinks about the inflation outlook. Now, if these sorts of dynamics play out in a more favorable light in terms of, let's say, we're seeing some evidence of wage deceleration, maybe that shows up as input cost deceleration, although I'm not tracking exactly the wages of how much like life insurance companies are paying their workers. So I think this is like, again, the sort of idiosyncratic mix of stuff can play some tricks. That if wages are decelerating and deposit rates are playing catch up, you could get a softer print on Friday. And if for no other reason than the Fed is reacting to this information, it could change how much they are willing to signal future hikes. I realize I just put some pretty ridiculous things that most people think of as micro, but somehow end up having some macro relevance. So yeah, I don't know if any of this stuff like is too arcane, but it's just kind of mind-boggling to me that such arcane stuff can like have pretty underrated leverage on like some kind of key macro decisions.
Yeah, I mean that doesn't surprise me at all. Everybody here, please make sure you follow Skanda Amarnath here on Twitter, and if you want to come up and ask questions, click that bottom left mic request button. As always, this will be an edited podcast on all your favorite platforms. Okay, I want to go back to Employ America because on the homepage you've got we're about full employment, and you've got a section there about trying to focus on wages, job quality, and talking about racial employment gaps. I'm always amazed at whenever congressional members talk to Fed officials how much there's a focus on Fed policy and wage gaps, from a racial employment perspective. I'm curious to hear your thoughts. Does the Fed really have any ability to close or widen, even at a small amount, some of these wage gaps that you see across across racial groups, across genders, or is that just sort of political brinksmanship?
I think that if you believe the Fed has some influence over, let's say, the unemployment rate, right? The headline unemployment rate or the headline employment to population ratio, if you think that they have some leverage over that, and I'd say they do. If they raise interest rates really aggressively, then they probably could cause a recession. And if they were trying to support the economy, they probably have some at least partial role in like an economic expansion. If you think that part's true, then I'd say the answer is yes, that there is And so I think the reason why I'd say so is black and white on employment, specifically on the racial side. I think it's different for other stuff like gender. It's not as obvious to me, but I'd say on the racial side, these outcomes tend to be quite cyclical too. So the employment gaps are quite correlated with the aggregate employment outcomes. Black and white unemployment rate gaps tend to be quite correlated with where the unemployment rate is, which is kind of a way of saying that probably where there are marginalized groups, people who may not be as employed, we tend to see that like economies that are dynamic, that are able to pull workers in as things heat up. Employers may be a little less choosy. I think of you see something very similar for those who maybe have a college education versus those who have a high school education, where high school education people who only have a high school education and not a college education tend to perform better at higher, like tend to be pulled into employment as aggregate employment rates go up. So we saw that in the later part of the 2010s. There was all this talk about how there was like, oh, these people are unemployable in the early 2010s, only to find out later that they actually can find jobs if the economy is good enough and can gain sort of valuable work experience. So I think like it's a place where the macro intersects with some of these more specific sources of disparity. Isn't like we call something like structural, like it's true in a sense, but the structural always interacts with the cyclical too. And so that's probably the place where I would like it. Is it a case where the Fed needs to be aiming for a particular type of employment outcome? Like let's say aim for a certain black unemployment rate or aim for a certain like high school educated people who lack a bachelor's degree. Should they be should the Fed be targeting that kind of employment rate? I think that's a pretty heavy-handed and like inappropriate way of framing it. But I think what is descriptively true is that these gaps can narrow as you kind of move higher up in terms of employment. And yeah, employers and employees you do see the kind of matching take place that, look, if you came out of the Great Recession and we're like headed onto the job market, I think employers definitely were a lot choosier at that time. They would kind of put college degree requirements in a lot of places that they probably didn't need to exist. And we've seen like some of that stuff relax over the course of the decade. And even now, I think employers are probably trying to get a little more creative about how they can like find new sources of talent that actually fit what they need to do and not necessarily what seems good, feels good, is like kind of more hierarchical as opposed to actually serving some productive purpose.
Let's talk about a piece that got quite a bit of attention recently that you guys put out, measuring wages in core non-housing services, signs of slowing. First of all, lay out for the audience why wages for non-housing services matters more than for those that are tied to housing.
This is a place where we're really trying to just take the Fed at their word here. The Fed's given some reasons for why they think that we're focused on the core services ex housing because we think that's labor cost driven. As with all things in economics that deal with causality, it's like you never can get like to some dispositive answer. You're not going to say, oh, we know for sure A causes B. I would say I'm pretty skeptical of what the Fed's laid out as like this is labor cost driven. But look, there's not, obviously labor costs. It's not that they don't matter at all. And if we're thinking about what the Fed is, the Fed's pretty much framed it as like wages go up, that pushes up cost structure for services firms, and when that happens, like that gets pushed through to prices. That's like the mechanics. And like there certainly are examples you can point to where that might be true. It's just like how big are those examples? How much of an effect are we talking about? But let's like just take the Fed in the sort of like the most charitable light and sort of take the steel man view of that. That's like a wage cost push view of things. If you want to do that the right way, then systematically track the wages that contribute to core services ex housing consumption. That's the stuff that's in PCE. So we have the data to be able to actually map that out. Take the information to take from the productive side of the economy to translate into from a given set of wage data that we have, and we get a decent amount of it. Control for the relevant biases, There's a whole set of sectors that matter in terms of how they feed into services output, specifically consumed services output. Those wages are decelerating pretty aggressively. They're now like back to within what I would call pre-pandemic norms. They're probably going to decelerate further based on some of the tea leaves. If I like, we're trying to take a slightly longer view of like say something the data over the last 6 to 9 months. If I look at the last 3 months or 3 to 4 months, it's actually been more call it disinflationary. So that's been largely, if you think about it, like one of the key factors here are leisure and hospitality wages, which saw a really big surge in 2021, 2022, probably caught off sides during the reopening phase of this recovery, where struggles to find labor, having to compete with the likes of Amazon for the same workers. If you can get paid better at Amazon to work in a warehouse, you may take that job over, or you might work in construction instead of working in food services or some other kind of recreation services. What we're seeing now is that like that sort of frictional challenge has abated for probably a few different reasons, among them that we're not like in the reopening phase of the recovery anymore. Maybe Amazon is no longer trying to be a hungry hippo about this, about sort of hiring labor, and maybe you're seeing just a better ability to attract workers, especially after a big wage adjustment in 2021. And so we're seeing that as wages are decelerating here, like the relevance from the, if we take the Fed's kind of use it reasonably face value and take the most charitable light of them, the wage cost push dynamic just is not as strong anymore. It's like, yes, wage growth in certain pockets, certain measures you can say is hot, but like if we're trying to think about core services like housing, if the whole idea of doing this like big, this disaggregated view of inflation, then I think the Fed should reckon with the fact that they are like, that is a more disinflationary dynamic. And I don't know how, I would not use that as my reason for forecasting core services like housing to be softer, just to be clear. But the Fed's own views here kind of has to incorporate this type of information in my estimation. Like if you're going to put this out as like the all powerful relationship to your understanding of inflation, you got to reckon with all the data that's relevant to it. So far, the Fed really hasn't. I think you maybe saw some Fed communications that are starting to notice what's going on in the wage data. But I'd say the Fed up till now has not really shown like any sort of, they've mostly said wage growth's just too high. And so they're mostly think that's where their characterizations have been sort of geared towards. That might change after Friday's wage data, but our sort of core services like housing analysis is like built around. So what is actually the labor cost pressure really looking like here? If you really think this is the key ingredient to this subset of the inflation picture.
Has there been anything that the Fed has done that's been surprising to you, given what you guys work towards and the kind of data that you put together? Something that you would say to yourself, you know what, they are way off in the way they're viewing whatever's happening?
Yeah, I mean, there's definitely a few places, especially in the inflation picture, where I'd say they've been, oddly enough, more optimistic than I would be about inflation. So let's take something like automobiles. If it's maybe they're starting to, they'll wisen up to, I eventually, but like it does strike me as like they've been telling a story is like, supply chains are getting better. Like the supply chain effects are no longer the issue in goods, and so goods, we're going to see goods deflate. And if you kind of are paying attention, especially to the automobile sector, it's like by and large, supply is still very tight structurally, just because automobile production domestically and internationally, for that matter, has been depressed relative to what we saw in terms of pre-pandemic norms. So it might be a combination of chip shortage, maybe some other input shortages, but like that problem's not gone away. And at the same time, we've seen, especially over tax refund, as more people got their tax refunds in kind of Q1 and through to obviously April, that there has been a demand dynamic too. So like as people who really need a car for their existence are willing to pay a premium, we've seen that used car prices have had a pretty strong run in the wholesale data first, and now more recently in the retail data. And so these things are not consistent with the supply chains have healed, and we've had this sort of situation. We're going to have like goods deflation, and that's embedded in the Fed's forecasts for inflation that they write down every quarter. And so to me, this is like a kind of place like if you were just paying attention to what's actually going on in the market data here, you would not be sort of running a victory lap here and saying goods deflation is like here to now. There's a different question about what the Fed should do about it, which I think is it's not obvious to me that higher rates is actually going to solve this problem in a positive light, because you're not just pulling lending from consumers, you're usually pulling lending from a lot of businesses tied to sort of the auto industry itself, and so that affects both supply and demand. It's not a given that like rate hikes are going to solve that problem, and if anything, we've seen what you really need to solve is that the supply situation has to improve. But the Fed just seems to have been so offsides on this dynamic until, I mean, there was one Fed governor who mentioned it last Friday, just before the blackout period, that she's more worried about it. But I think by and large, the Fed has been singing a very different tune. And it's like, to first understand where you want to go, and especially if you want to be forward looking and not just be lagging the data and reacting to the data, you got to have your finger on the pulse of what's going on. Otherwise, they're kind of left in the same situation that kind of got exposed with sort of like the transitory fallout, right? They tried to say, oh, this stuff is transitory. It's going to be maybe a spike one year, but it's going to go away within a short period of time. And it's like you had to, you're better off warning about that upside first, and so that people don't think you're like lacking credibility in understanding inflation. Like that's the part that seems still quite surprising to me, that like it's taken so long for them to, and even now there seem to be still quite behind the curve on just understanding the more relevant inflation dynamics. It seems like the stuff seems to be like just on the edge of their radar.
Is there anything that you think could really surprise the Fed that maybe that you think they're not paying that much attention to? And to me, I've been just looking at the velocity of money, which has been in the gutter for a while, but seems like there's maybe a little bit of a sign of life going on there. And if you get a sudden surge in the velocity of money, then suddenly you have another spike higher in inflation. Right? Everyone focuses on money supply, not just the velocity side, because velocity's been dead for a while. But what are some of the things that you think the Fed could get surprised by?
Yeah, I'd say that if you're thinking about things from the upside scenarios, the stuff that's probably not baked, like the Fed's like own perceptions of growth itself. Like I just think about people talk about like velocity of money and money supply, right? Like MV equals PY by sort of Friedman equation, right? That would just tell you it's like money supply and velocity feed into nominal GDP growth by construction. So nominal GDP growth itself has been slowing, but not in this kind of alarming pace that like you think of as the recession, right? And I think that's a place where, look, market consensus probably continues to say things like recession is definitely going to happen, which I think, again, like beware certainty in these contexts. But actually, if you look at like where the Fed even is projecting the economy through the last 3 quarters of the year, it also is consistent with the recession. The unemployment rate is supposed to go up by a percentage point. GDP growth is supposed to be basically negative, or I don't see how really you can escape a negative outcome if the Fed's projections are right. And they also think that's going to cause inflation to slow down. So like, let's think about like if we are seeing signs of resilience, what you're talking about in terms of velocity is like another way of saying is like, look, there's a lot of the economic data on the spending side has shown more resilience. So you can see that in like, it's probably the case that retail sales weren't as hot as January, but it's probably the case also consumption is not sinking into a pit. Likewise, housing, which took a big hit in 2022, it seems to be seeing more signs of at least stabilization, if not a local upturn. If you look at some of the stuff like the sales data plus the permits and starts data, we seem to be hitting some kind of stabilization point. Maybe that's like maybe that sort of stabilization point is like short-lived, but like it is like telling that actually the things that were a drag on growth are going to be less of a drag now and could potentially even be a contributor. I think it's a similar story for manufacturing. You're kind of seeing signs that the global manufacturing cycle is improving. So all these things are different parts of that nominal GDP beast. That again, to me, the story I would tell about U.S. growth right now is we're seeing a slowdown, but it seems to also be stabilizing into a potentially non-recessionary outcome. And if it shows signs of resilience, that's what you're talking about in terms of velocity. The worry, I think, if the Fed's forecasts are offsides, what does that make them do next, right? If they say, oh, we thought that growth was going to be weaker and inflation was going to be weaker, but turns out growth is stronger, and that must mean inflation might be stronger. These are that's the kind of surprise you're talking about that probably is relevant for where we might see the next Fed pivot kind of come from. And obviously the GDP data this week is, I say, it's pretty stale news, but it probably will raise the question of, hey, the Fed's forecasts for GDP growth this year are in one place, and if the realized data is stronger. So that's certainly one way to swing it. I would the other side that I think of as sort of being the potential thing that's like, if we're going to talk about more scenarios where the Fed maybe is more prudent and more cautious, it's going to be things around the wage data that might change, that might trigger that shift. Because again, I'd say right now the Fed's mostly talked about the labor market being hot, but it is showing signs of like kind of cooling on its own too. We're seeing more signs that wages are decelerating on a few different measures. It's possible that may not, like, different measures are going to tell you different things. Maybe Friday we'll see, but if wages are decelerating and we see other signs, like obviously people talk about job openings declining, the measure I like a little bit more is just looking at whether workers are voluntarily leaving their firms, trying to shift to different jobs. And that number is also declining. So we're seeing that sort of labor turnover rates are cooling. Wage growth, a lot of measures, is cooling. You put those things together, that is probably the scenario where the Fed says, how much do we really need to hit the economy with a hammer here? Maybe we can take a moment to reevaluate where we're going, and we don't have to sound so dogmatic and kind of posture so aggressively.
For those in the audience, Skanda, who want to learn more about what you do and access some of your research, how do people find you?
Yeah, so we're at employamerica.org. You can contact us if we have both public research that's mostly for our, consistent with our mission. We also, for those who are like premium donors to us, we try to provide some of the sort of the research we do behind the hood to kind of give us the best understanding of where the economy is and where it's going, and stuff that's a little more detail oriented, the kind of stuff I've talked about here. So you can reach out to us on our contact us page, or if you're interested in our research. But yeah, we'll be firing away with more things about Fed, macro, and obviously what it means for the economy as a whole.
It's a good place to wrap this Twitter space up. I have another one in about 10 minutes with Michael Kramer. Stay tuned for that. Please make sure you follow Skanda Amarnath here on Twitter, and I'll see you all next time. Thank you, Skanda. Appreciate it.
Thanks, Michael.
Cheers, everybody.